talk about the other issue that the market will now have to deal with, the changes in the ULIP. Sanjiv Bajaj of Bajaj Capital joins in to talk about that. Sanjiv, morning. Your preliminary analysis of this changed ULIP form and whether it's going to make any big dent in volumes, you fear?
No, I think the new changes are actually for the betterment of the public. There have been certain changes made, like ULIPs are positioned as long-term products, but there were some people who were misusing the 3-year norms and they were being sold as a short-term 3-year product. So now with the changes, now they are clearly defined as a 5-year plus product. So to a certain level, the industry and the agents and the brokers will have to work harder, but the positioning will be better. So in the long run, I think this will be more beneficial for the industry, and the industry will be able to get more long-term money, and that should be helpful for everyone, including the stock markets.
What does it mean in the short term, Sanjiv, particularly for distributors? Because clearly distributor commissions will be impacted. Do you think they will be impacted to an extent that selling ULIPs will become relatively unattractive for them? Or do you think it may not have such a big impact on volumes through that route?
See, distributor commissions have already come down with the new regulations which specified a minimum yield loss. In fact, this circular to a certain level seems to have, given certain relaxations on that. But what will happen is that the capital requirement of most of the insurance companies may go up, because what they have said, there were some plans which were charging a lot of money upfront in the first 2-3 years. Now, what they have said is that whatever the charges that you have to charge it evenly over 5 years, or that is the new lock-in period. So what it will do is that a lot of companies will actually have to invest more capital in order to smoothen out the charges. To a certain level, it will be beneficial for the consumer that he will see an equal amount of charges. It's not that the first year majority of his money is going towards charges. The next year onwards there is a high allocation. To a certain level, some distributors may see a reduction in volume of what they are mobilizing, because these products are long-term, and long-term products means lower volumes, and you have to put more effort in convincing the consumer. But to a certain level, but in the long run, since these are regular premium plans, the amount of money that will go towards the market will go up significantly. So yes, it's like a bitter pill which is for your benefit. So in the short run, it may see certain reductions, but I think overall it will be for the benefit of everyone.
So you don't see a mutual fund kind of situation that happened last year, that selling becomes quite unattractive for these ULIPs or difficult for these ULIP products, and we see a drying up of money mobilized through this instrument?
No, I think the current set of circular has kept both the distributors as well as the insurance companies as well as the public in mind, and it has come out with regulations which are fair to everyone. What I am slightly concerned with is the pension circular pension point, which says that minimum 4.5% return will have to be guaranteed. That would actually mean that most of the money that is being invested in pension plans will have to be in a majorly debt plan. So what that will do is that a lot of pension money, which could have also gone into equity, and if a person is planning to take a pension after 30 years, it makes more sense for him to be invested in equity, will now be invested more in debt. So that will result in reduction in his yield over a long period, and he is being over safe, as I'll say. So that is a slight cause of concern, because that will totally change the way products are being sold, and to a certain level, people may not get the rightful return, but the products will be more easier to understand. So that's a concerning point, that if there is a long term available, then the asset allocation should be based on the term, not predefined, that where 4.5% return plus principal has to be given. That would mean that 70 to 80% of the money will have to remain minimum in debt.
Just with reference to these insurance companies, Sanjiv, because it impacts companies like ICICI Bank, I'm quoting from one of the analyst opinions put forward. Capping of surrender charges is a bigger blow compared with capping the difference between gross and net yield, because that will not only restrict the ability to generate revenues, but it also then raises the persistency risk for insurance companies. Are you quite certain that it's a big positive for the insurance companies, the changed form of ULIPs?
Yet, there have been certain relaxations which have been given in this circular. Earlier it was said that ULIPs and pension products also, all pension products need to carry minimum 5 times life cover. Now that seems to have been relaxed a bit, because to a certain level, a lot of people who invest in pensions are not looking for life cover. So that to a certain level, that is a big plus for the industry. Also, it has been defined that if there is a short PPT, the minimum yield loss in those cases have been defined. So to a certain level, it is stricter for the industry, but it is for the betterment of the public. And whatever is for the betterment of the public, eventually the product survival or the survival of the insurance company depends on how this product is perceived by the public. Now this yield loss may be slightly difficult for companies. They have to give up some of their yield, but to a certain level it gives more fair value to the consumers. And when consumers are getting more value, and when the media explains this to them, eventually the volumes will go up and it will be for the betterment of the industry.
From a retail investor's point of view, Sanjiv, is it still the most or one of the most lucrative products to be approaching the stock market via?
See, with retail investors to a certain level, yes, because to a normal investor today, with the reduction in the charges on mutual fund, nobody is actually offering them an opportunity to invest through mutual funds. If a person wants to buy a mutual fund and he's retail, it is very difficult for him. He will actually have to go out, actively search and find a distributor. Whereas ULIPs has a huge amount of 30 lakh agents who are chasing you, running after you, reminding you, he come and invest. And to a certain level, like if you are investing in the market for long run, now the insurance companies also know that they will get minimum for 5 years. So imagine they will be able to take much better calls on equity. They'll be able to take much longer calls. They know that this money is more stable. There is no corporate money. There is no big money. They will not face sudden redemption pressure, so they don't have to maintain cash positions. So to a certain level, I think they'll be able to invest better in equities. The stock markets will get much more stable money. So, and in the long run, these ULIP plans should be able to build up very good funds, and they should be able to deliver great value to the consumer. So yes, if a consumer is definitely looking to invest for more than 10 years, I think ULIP is a great plan, but they have to understand ULIP is a disciplined investment. It is not an investment that you can make today and forget about it tomorrow. It's not a 3-year investment anymore. It's a minimum 5-year and preferably 10-year plus investment where you are committing yourself to paying the premium regularly. If you don't pay your premium, you will lose money. That is very, very clear.
Thanks, Sanjiv, for your thoughts on this new product. Let's now